Hello, everyone. We're looking at the question of industrial policy in South Africa and the evolution of South Africa's economic trajectory. I'll start by just a little bit of a background on the conventional understanding of the nature of the South African economy, which we're going to contrast with our own understanding of the South African economy. I mean, obviously, we're talking about the largest and the most industrialised economy in sub-Saharan Africa. So, you know, what happens in South Africa has obviously got big implications for other economies and for the continent as a whole. And I guess, you know, from other parts of the continent, you might think there's a lot of successes to be emulated in terms of skills or capital-intensive industry or infrastructure provision and so forth. I think partly we're looking more at how do we disaggregate the experience more, and how do we look at some of the problems and some of the issues and some of the tensions, really, in the success story notion. Particularly when people talk about the success story, a lot of the focus is on the growth and the expansion of South Africa's financial sector. Of which we've done other joint work on, which we're going to focus on today. But clearly, the evolution and the development of South Africa's financial system is very, very important in terms of understanding industrialisation and deindustrialisation, and actually the challenges for industrial policy in South Africa today. Now, just we're talking about a fairly moderate growth experience since 1994. Obviously, 1994 political liberation a key turning point. So, you know, so we've got moderate growth, but we've got this moderate growth combined with what's often referred to as the triple crises of poverty, unemployment, and inequality. And so, a lot of what we're doing in our sort of analysis of the South Africa's evolution, both in terms of industrial structure and industrial policy, is in part it's a question of how do you explain the triple crises and how do you address the triple crises. And that's you know, that's a central question for policymakers, but also very, very important for understanding the dynamics of the society and so on. You know, we could talk about PUI at great length. We don't have time, but obviously, you know, we're talking about official unemployment, the narrow measure of unemployment at 25%, 30% by the expanded definition. You know, there's a crisis of unemployment, so the very, very important question for industrial policy is how to generate employment. So just in terms of the basic sort of outline, the sort of conventional analysis, we look very, very clearly, we see services in terms of sector contributions to GDP. Services obviously very, very important. And we see agriculture down the bottom, and then manufacturing and mining and quarrying. And it's quite common to talk about the decline of mining's importance in South Africa, which we challenge. Again, if you look at employment, again, very important, services up the top, mining and quarrying down the bottom, manufacturing, agriculture. So there's the whole question, has South Africa diversified from its historical resource dependence? We should look at export values here in constant prices. It's a very interesting picture, I think. It's a conventional picture. We see services down the bottom, you see manufacturing, and you see mining and quarrying in the middle, looking perhaps far less impressive than services. But there's a huge caveat we want to introduce, is if you actually rearrange the official categories. It's very important for your picture of how the economy works. So if we look at mining and processed mining products together, you see a very, very different picture. So if we take processed mining products out of manufacturing and add processed mining products in with mining and quarrying, you see that's actually a very, very, very strong sector. It's actually the core of the economy. So you see the manufacturing less processed mining products. It looks very different in that light. So that's a sort of overview of our approach. If you look at the core of the economy, it's mining and processed mining products are actually very important to understand together and to disaggregate the notion of manufacturing. Because South African manufacturing, once you disaggregate it, looks very, very different. So our approach then is in terms of, I think we're sort of located in a classical political economy sort of approach. So we're very concerned with the nature and the dynamic of capital accumulation in South Africa and economic growth in a dynamic historical evolution. So what we'll present today is actually very much a historical story that tries to bring together and integrate the elements of the story in that historical evolution. So we're looking at class formation and how that's evolved over time, and how that's formed a particular industrial structure, how industrial policy has helped to form that particular industrial structure in particular interests. And then we'll have the story post-1994. How was that addressed at 94? But then also, where does that leave us today with this enormous legacy still to be addressed? And we use the term, I mean, I think in terms of theoretical framework, we have our own sort of eclectic mix probably of Marx, Ashman and Kaldor in a strange idiosyncratic conjunction, but particularly we use the notion, which is Fine and Rustamji's notion of the minerals energy complex, which is that the importance of disaggregating the manufacturing to get a different picture of the economy. So, shall I give you this? Okay.
Right. We'll try and do our transitions and relay as smoothly as we can. So Sam's outlined sort of our motivation a little bit and a bit of background as to why we're interested in the historical approach to understanding what we understand as the structural roots of the problem of unemployment and inequality in South Africa today. And as Sam mentioned, we look at this through the prism of what is known as the mineral energy complex, which is a very complicated notion. And in order to be a bit clearer and instrumental here, we're just going to draw on two aspects of that for this presentation in order to illustrate the dynamics between class interests, the way in which industrial policy is shaped, and how that interacts and relates to the outcomes in terms of industrial structure, what that means in terms of the persistence or hysteresis and path dependence of the industrial structure within South Africa, coming from apartheid and into the present period. So the MEC, Mineral Energy Complex, is an analysis of industrial development which looks at different dimensions, particularly of interdependencies between fractions of capital, industrial sectors, and the state. And these are interdependencies which, dimensions we look at are both interests, competition, as well as interdependence of various fractions of capital, the state and society. So dimensions this, but not limited to, is an economic and political analysis which emphasizes the evolving class relation and conflicts, as well as a need for cooperation, and how this then is reflected in the pattern of accumulation and economic and social reproduction. Another dimension of it, which relates much more closely to Hirschmanian type linkages and cumulative causation of sort of the Kaldor type models, is that of the empirical identification of the MEC as a set of sectors which are linked, very tightly linked in the input-output sense. Okay, so we have a set of coherent industries with very, very strong linkages with each other in the input-output sense, and relatively weaker linkages with sectors outside of this MEC core. So this is a material identification of the boundaries of the MEC based on this sectoral understanding. And what I want to emphasize here is that we see very, very strong linkages between these various heavy industry sectors that are tied to mining and extractive industries with one another, whereas manufacturing outside of those sectors are very weakly linked to that MEC core. Now, why is that important? Well, the importance of it is that, and we'll go into how this has developed out of the historical evolution of industrial policy. But what this means for the South African economy today is that you have a set of industries very closely linked with the sort of reinforcing nature of this. So you have an expansion of one pulling through demand and linkages on the expansions of others. So we can see this reinforcing positive cycle of this set of industries that happens in relative isolation, and we argue even at the expense of manufacturing's outside of this core. Manufacturing, particularly in wage goods, consumer goods, those which are labor intensive, that rely on broadening out of the domestic market. But this is very particular in the case of South Africa, owing to its the apartheid past. Okay, so I think now I hand back over to you.
It's an advantage when you think closely together, but sometimes it's hard to break it down for presentational purposes. Okay, so I'll try and take us through the apartheid period, and then Susan will do the post-apartheid period and do the conclusion. A very important part of the story of the apartheid period is the attempts to form an Afrikaner capitalist class, which is both in competition with English mining capital, but dependent upon it. So what does that mean? If we think the industrial development is rooted in English mining capital, in diamonds, but then critically gold in the Witwatersrand in the 1890s onwards. So it's critically developed by English mining and finance capital. And there's, particularly in the 20s and the 30s, there's a developing crisis of poor whiteism. And so a lot of the project of apartheid and Afrikaner nationalism is how do you concentrate white Afrikaner savings to create a pool for investment to build up Afrikaner capital on a sufficiently big basis that it can compete with big English mining capital. And how do you do that at the same time generating steady employment for whites on an exclusionary basis? And so we see industrial policy in the apartheid period really geared towards this mission, this strategy. And we see Afrikaner interests in control of the state, particularly from 48 onwards. Well, there are important developments prior to 48, but I'll leave those for now. So industrial policy then is critically as a means to create an Afrikaner industrial class. And over time it erodes the disjunction between Afrikaner and English-speaking capital. But there are lasting effects from how this is achieved. One is a promotion of finance, and you see the development of huge Afrikaner-based financial institutions. I mean, if you look at ABSA, one of the big four banks in South Africa today, it comes out of the amalgamation of various smaller Afrikaner financial institutions over time. Also breaking into mining interests, so you get formation of white mining interests. But very, very important is the question of the state-owned enterprises, particularly energy, and the national energy company, Eskom, providing cheap inputs, being a vehicle for this process, but being interdependent with white English mining capital because of its provision of a cheap, steady supply of electricity to the mining industry, which is absolutely critical, has enormous impact on industrial policy towards the coal industry, because the whole electricity sector is obviously fueled by another mineral, coal. Actually, and really, in lots of ways, South Africa was and remains a coal economy. It's a very, very boring, simple commodity, but it's fundamental because coal is the basis for the cheap electricity supply, and which kind of sums up the interdependence between the two sectors, as well as their competition. So you have the importance of these state-owned enterprises, energy, but also steel is very, very important. Combined in terms of industrial policy terms with heavy protection of consumer durables, to serve a very small, limited white market. And both in terms of consumer durables and in terms of electricity provision, you know, if you draw a map, they're so geographically skewed, it's extraordinary to exclude the majority black population. Labour-intensive activities are generally small scale and, as I said, focused on addressing the poor white problem. Now, all this leads to conclusions about what sort of capital-intensive sectors you get. You get very heavy capital-intensive sectors, which one might, is the strength of the economy in some ways, but they're shaped through this process in terms of how they come about and who they're designed, what interests they're designed to meet. So you get a very heavily skewed industrial structure, and with a very highly concentrated ownership pattern, which is over time, as the disjunction is eroded, actually what you see is the formation of really 6 conglomerate groupings, which combine mining, finance, and manufacturing activities within each conglomerate grouping. So really, you've got six groupings which, by the 1980s, really dominate the entire economy. But what's very important here to say is that the goal of industrial policy in this period is not broad-based economic development. That's not the goal. It's the development. It's Afrikaner capital breaking in and generating skilled work for white workers. Obviously, premised on massive numbers of cheap black labour. So you know, it's a very particular history, and it's a very particular kind of industrialisation path. But it's kind of important to grasp how that leaves the economy. Very, very capital intensive, core sectors, energy dependent. I mean, there's a very good collection of essays called Electric Capitalism, which tries to summarise this process as a capitalism that's very much based on electricity. Okay. So, the most important thing here is what's in red, which is the difference between 48 and 75, the growth of heavy industry, which is what industrial policy in the apartheid period is about, as I'm trying to say. It's about the growth of heavy industry relative to light industry in this case, as a share of total manufacturing. It's a very, very important part of the picture. So again, if you look, contribution. So if we remember our distinction between MEC and non-MEC sectors, contribution of these two sectors to gross domestic output. Again, it's very, very important, very, very interesting when you break it down, and also when you see it over time. So if we look, obviously we've got the MEC with the is the second one down. Finance and business services actually growing steadily, but we'll see it in a minute shoot up enormously. We've got non-MEC manufacturing, and then if you look at really the top line, MEC, if you include transport and storage, because what's also in part of this industrial policy process is that infrastructure provision is very much geared around facilitating this particular form of industrial development. So that's MEC, including transport and storage, is very, very important. That's a contribution to gross domestic output. Exports, similarly important story. You know, if you look, say, mining and quarrying, looks like it's on a sort of downward trajectory. Actually, if you look at MEC manufacturing, you see that that's not an accurate picture. And then if you look at MEC total, we're talking overwhelmingly dominant across the top. Employment, interesting. Well, I'll start with the most obvious thing here is particularly since '85 onwards, the increase in employment in finance and business services. the implication of this, Susan's going to talk about this a little bit more. But then again, you see, again, you've got non-MEC manufacturing. Above it, you've got MEC manufacturing. And then at the top, for most of it, you've got MEC, including transport and storage. So you see, I mean, this really is the absolute core of the economy. But particularly from the late 80s and then the 1990s onwards, we have to look at the question of mining and finance. Because you see an economy which remains, in changing ways, dominated still by mining and finance. And the rise of finance and the sorts of employment that's giving rise to. So,
Sam has to deal with a longer period of history than I do. So, let's try and get the late 80s until to present day in the next 4.5 minutes or so. So a corollary or an outcome or outcrop of the particular nature of industrial development under apartheid was, as we mentioned, a very skewed industrial sector towards heavy industry, tightly linked around mining and mining output, or the beneficiation, precisely the type of resource-based industrialization that's being discussed quite a lot so far today. But this is a particular outcrop, and we see this disjuncture between economic power and political power being eroded, and South African economy controlled by 6 diversified conglomerates. What we see is an unwinding of some of this in the late 80s, early 90s. So we see a push already driven by particular interests of capital in the late 1980s and early 1990s towards financial liberalization. So for example, the banking sector was liberalized in the 80s already. And one of the reasons for this was the fear of capital from political transformation. So there was a reluctance of capital to invest in fixed assets. So we see a building up of so-called trapped capital under economic sanctions that boosts and builds up the financial sector, which is then liberalized and expands even further. So South Africa has a very, very deep and very, very sophisticated financial sector. We've heard this discussed earlier, internationally competitive. And what we also see is pressures to liberalize the capital account, financial liberalization more broadly, for capital flight or some sort of ability for capital to withdraw from the economy in case of problems associated with political transition, but also the potential gains that could be made with global reintegration. So particularly from financial accumulation that we've seen so far, engagement in global markets more generally. So what we see from 1994 is a macroeconomic policy, 1996, GEAR, so growth, employment and redistribution, which is quite ironically named, we would argue, comes into practice in 1996 and serves very particular class interests. It basically allows for massive offshore listing and what we call a managed capital flight, seeking to benefit from global markets. We see an industrial policy at this period, particularly with ASGISA, which is very narrowly focused on stable macroeconomic environment. And where there is industrial intervention, it's scattered and very small scale. For example, in the MIDP, the support for the motor industry, and supply side oriented. It's not taking into account particularly domestic demand either through consumption or through investment. So what we also see, because as I mentioned already, the sort of coherence and self-dynamic of the MEC sectoral structure, we see that any gains that were made in terms of industrial diversification, of which there were very few during the 1970s and 80s, were very quickly unwound as you get competitive pressure externally, as well as deconglomeration, as these conglomerates refocus on core capabilities and shed off their any manufacturing they had previously. So this is just to show that actually what's been happening is that we see a consolidation or increase in capital stock across the MEC, as well as services, and a stagnation or decline in non-MEC manufacturing. So deindustrialization is in a very particular area here, that of labor-intensive products. Okay. I'll probably skip through these. These are showing similar pictures. But what I want to just say in the last minute is what are the consequences of this, and what are the implications of the prevailing industrial structure that's been very much shaped by class interests as they change over time, to the possibility, or what are the challenges and constraints for industrial policy today in South Africa. So first of all, it's a very peculiar macroeconomic constellation of policy at the moment, which it's very difficult to break, okay? And I think, so macroeconomic policy, that of Washington Consensus, of inflation targeting, of liberalized capital accounts, set into a chain of interdependencies. So on the one hand, you want trade liberalization has increased imports and much more volatile export earnings. This has led to a very persistent current account deficit in South Africa. This is the largest in terms of the share of GDP for any economy of comparable level of income. At the same time, you get a very strong defense of inflation targeting and very high interest rate policies in order to manage inflation on the one hand, but also to attract short-term capital inflows to offset or maintain the balance of payments that's being drawn down by the current account deficit. What does this mean? This means there's a reduced amount availability of funds for long-term investment, both in terms of the high cost of borrowing associated with a high interest rate, as well as maturity mismatch on the balance sheets of financial institutions. Short-term inflows on the one hand don't match with long-term investable funds for innovation and productive investment. We also see a further inflation development of the financial sector very clearly seen, and this has also meant, whilst yes, there has been gains in the services sectors, some of the service sectors, particularly wholesale and retail and financial and business services, this is highly cyclical and in part credit-driven. So this is not the same kind of, we would argue, sustainable long-term employment that you would get from a broader, more integrated industrial structure in South Africa. So a question arises then, is this premature deindustrialization? And I'll leave that up to you with this graph without going into it because of time. But thank you.